We spoke about how the doji is a signal of indecision, and the gravestone doji is actually a bearish type of doji candlestick that indicates a downside reversal. It should appear in an uptrend, which we have defined as the presence of a new 10-day high. It should have an extremely narrow body with long upper shadow and a very small or non-existent lower shadow. And the longer the upper shadow, the stronger the reversal signal should be. So this candle shows that the market has gone to new highs with a fair amount of strength, but then it's been brought back down by the sellers and it's closed right where it started. So this is an indication that the market is losing momentum and therefore that the upward trend could reverse in the future. And here's a gravestone doji setup that we can see in silver. In this example, the gravestone doji did a poor job of spotting the reversal, which is so often the case with some of these patterns. So, using the formula we created, we can identify the gravestone doji on the chart and see how it performs as a short signal. In this first table, we see the results of shorting a gravestone doji pattern as we defined it on the close and then holding the trade for one whole day. As you can see, the pattern produced an average loss of 0.27% in our 21 markets with a win rate of 45%, and it produced an average loss of 0.18% in stocks, and both figures were much worse than the benchmark return. With a 3-day holding period, the pattern also did poorly, recording an average loss of 0.52% across our 21 markets, and it did just as bad with a 5-day holding period and a 10-day holding period. In fact, you can see that shorting a gravestone doji pattern is not a profitable pattern to look out for. The strategy has a low win rate and lost money on every test. Next, we'll look at the dragonfly doji.